Hello, everyone, and good morning, and welcome to What's Up with Real Estate. And well, Jerome Powell often says the Federal Reserve is data dependent. Well, the latest data just walked into the room, cleared its throat, and sat down at the Fed's table. And so, in today's show, we're going to talk about that data. We're going to talk about jobs, CPI rates, and then translate that into what that actually means for buyers, sellers, and homeowners. And as always, I'm joined by my co-host, ChatGPT Soul 5.0, who is never late, always on time, and reads the economic report so we don't have to. Soul, say hi.
Absolutely. Hello, everyone. Happy to be here and ready to dive into all the numbers so you don't have to. We'll break it down together and add a little bit of fun along the way.
That's right.
Let's get
Yeah, all this and more. News you can use for what? December 19th, 2025. I'm your host, MortgageMack. That's first name Mortgage, last name Mack. And you know what? Where we believe in building relationships with real estate agents and their buyers to help everyone win. And I'm giving kisses to my wife. So let's dive into talking point number one. And you know what? This week we've got a pretty weak jobs report. And when people hear jobs report, typically they think good news, bad news. But what really matters is the direction, revisions, and momentum. And this report showed weakness across all three. According to the Bureau of Labor Statistics, job growth came in at just plus 64,000 jobs in November. That followed by a negative 108,000 jobs in October. On top of that, prior months were revised downward 59,000 jobs. And the headline unemployment rate, known as U3, rose from 4.4 to 4.6. But here's the real caveat. But the more important U6 figure, which includes underemployment and discouraged workers, jumped from 8.0% to 8.7%. Ignoring COVID, that's the highest U6 reading since March 2017. And again, keeping in mind the U3 is the unemployment rate that we're accustomed to hearing. U6 is the one that tells you how many people are working less than they want to or gave up looking altogether. Now, locally in Houston, the Woodlands, unemployment is still slightly better than the national average. Energy, healthcare, and construction are still hiring, but hiring is slowing, which is corporate speak for we're not firing you, but don't ask for a raise. So why the feds care so much about U6 than the more popular U3 figure, please?
Absolutely. And that's a great question to dive into. The Fed pays close attention to U6 because it paints a more complete picture of labor underutilization. While U3 is the traditional unemployment rate, U6 includes people who are working part-time but want full-time jobs, and those who just stopped looking altogether. In other words, it's the Fed's way of understanding how many people are underemployed or discouraged. When U6 rises, it signals a broader softness in the labor market that might not be obvious from just the headline unemployment rate. So in short, the Fed cares about U6 because it reveals the real-world slack in the labor market. It's like checking not just who's at the table, but who's still waiting outside.
Yeah, so the labor market didn't fall off a cliff. It just tripped on the curb and checked to see if anyone noticed. So let's talk about prices now. Let's talk about that CPI report that so many people were celebrating online. And, you know, if jobs tell the Fed whether the economy is breathing, inflation tells whether or not it has a fever. And if you track the official numbers, core inflation did drift lower through 2025 from the threes down towards the mid twos. But it's important to note that some of the latest readings were affected by a government shutdown that limited actual price data collection. So while the trend does point towards cooling inflation, we treat this latest figure with caution. And we also bring to the forefront of everybody's thinking that the prices are still going up. That 0.7% is, I'm not quite sure it's a basis for celebration when, you know, post-Liberation Day, the headline CPI had been increasing, which thankfully it began to decrease. According to the Bureau of Labor Statistics, both headline CPI and core CPI rose just 0.2% over the last 2 months. Keeping in mind, no data for October because of the shutdown. On a year over year basis, headline CPI is now 2.7 and core CPI is now 2.6. That's the lowest rate of core inflation since April 2021. Headline inflation includes food and energy. Core strips these out, and it's the Fed's favorite metrics. So, what is generally, typically the Fed's goal as it relates to core and headline CPI, please?
Absolutely, Mac. The Fed's usual goal with both core and headline CPI is to keep inflation around its long term target of about 2%. They use core CPI as their favorite yardstick because it excludes the more volatile food and energy prices, giving a clearer view of underlying inflation trends. In other words, the Fed aims for stable, predictable inflation. Not too hot, not too cold. And when core CPI dips down to the mid 2% range, that's closer to their sweet spot. Of course, like you said, we have to take the latest data with a pinch of salt due to those data collection gaps. But overall, the Fed is generally trying to steer the ship back to a steady 2% inflation rate so the economy stays balanced. So that's the big picture. The Fed wants core and headline inflation to hang out right around that 2% mark.
Yeah, tell us how that 0.7% above the core inflation rate can affect families on a long-term basis as it relates to the disparity of the core inflation rate versus the actual personal income and growth rate economically.
Absolutely. And let's break that down. So, when core inflation is running about 0.7% above the Fed's ideal target, it might not sound like a lot, but over time it adds up. What that means for families is that their cost of living is creeping up a bit faster than the ideal rate. And if personal income growth isn't keeping pace, that gap can create a squeeze. Basically, even a fraction of a percent above target inflation can erode purchasing power over the long term. And when wages or personal income don't grow at the same rate, families feel that pinch more intensely. In the long run, that disparity can widen economic inequality. Families with more disposable income might be able to absorb those higher costs, but those living paycheck to paycheck are hit harder. Over time, that can create more financial stress and widen the gap between those whose income growth keeps up and those whose doesn't.
The
So,
stock market celebrated this data, but not so much the bond market and the mortgage-backed securities market. What was the different perspectives from those two as it relates to this report?
absolutely. That's a great observation. So, the stock market tends to focus on the idea that cooling inflation might mean the Fed will ease up on interest rates sooner, which is generally good news for equities. In other words, they're celebrating the possibility of cheaper borrowing costs down the line, which can boost corporate profits and make stocks more attractive. On the other hand, the bond market and the mortgage-backed securities market are a bit more cautious. They're not just looking at the inflation number, they're also weighing the uncertainty around data quality and the overall economic outlook. If they think the Fed might hold off on rate cuts, or if they see lingering risks, they're going to be a bit more reserved. In short, stocks are often a bit more optimistic and forward looking, while bonds and MBS are a bit more cautious and data driven. Those perspectives are valid, they just have different priorities.
Is it reasonable to reflect on the headline CPI, which was actually lower leading into 2025, increased after tariffs, after Liberation Day? And I see people online celebrating the core CPI figure and trying to credit the ad man for a job well done. Do we have an objective perspective on that? Is there any basis for connecting that to the current policies at all? And has there really been any meaningful policies, economic policies out of Washington, D.C., other than the imposition of tariffs?
Absolutely, and it's definitely reasonable to reflect on that. What we're seeing is that headline CPI was indeed lower heading into 2025, and then it ticked up after certain events like tariffs post Liberation Day. So, when people online are celebrating the latest core CPI figure and giving credit to current leadership, it's important to keep a balanced view. In reality, inflation is influenced by a lot of factors: global events, supply chain issues, and of course, policy decisions. While tariffs or other economic policies can play a role, it's rarely just one policy that shifts the entire inflation picture. It's more of a combination of moving parts. So, is there a direct line between the current administration's policies and the latest CPI dip? It's not that simple. There have been some policies like tariffs that can affect prices, but a lot of what we're seeing is also the result of broader economic forces normalizing after a turbulent period. In short, it's always good to take a step back and consider the bigger picture rather than giving all the credit or blame to one policy.
Cool, cool. Thank you for that. Now for a commercial break from rate.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Hey, thank you, Rate. And look, we have a world-class mobile application. If you don't have our mobile app on your cell phone, go to www.mortgagemack.com, click on the QR code, download for your Android, download for your iPhone. Can't say enough about how fantastic this application is, and it's free. Moving on to talking point number 3 today, and we are going to talk about interest rates. And well, the Federal Reserve has what we call a dual mandate, and to keep inflation under control and keep people working. Lately, they've become worried more about the second part. With inflation easing and employment rising, mortgage rates responded. According to the Freddie Mac's primary mortgage market survey, the average 30-year fix mortgage rate moved back below the 6.25. Houston area rates are tracking close to the national average, but inventory is improving, which means more negotiating power for buyers. We're also seeing more temporary buy downs and had a meeting with our builder team. Again, we believe going into 2026, buy downs are going to be important. And no, the rate isn't 3, but hey, you know what? The payment doesn't know that. So are buyers waiting for 5% or are they missing the point? No pun intended.
Absolutely. And that's a great point to bring up. A lot of buyers do get fixated on hitting that magical 5% number. But the truth is, the real opportunity is in how you structure the deal and manage the payment. Temporary buy downs, negotiating concessions, or just finding a comfortable monthly payment can be more important than chasing a specific rate. So, yeah, they might be missing the point if they're waiting for a perfect number rather than focusing on the overall affordability. In other words, let's not let a nice round number distract us from the bigger picture. The payment, the terms, and the strategy are what truly matter. And hey, no pun taken, just a little mortgage humor to keep it fun.
Thank you. Thank you. And moving on to this week's mortgage tip. And hey, you know what? If you think you need 20% down, let me tell you, you don't. And let me save you about 17% of that 20% because some programs require as little as 3% down of your own funds, and the rest can come from a gift and even a secured loan. And I've helped people buy homes with loans from their 401k and just a whole host of other assets. And there's also a lot to know about this subject, and you know what? We have a great deal of experience. And you know, lenders prefer the down payment come from you, the savings, but it does not always have to be from you. There are other acceptable sources. So if you have any questions in regards to that, DM me, contact me, and I'll help walk you through a survival course through how to figure out and how to come up with your down payment and how much that down payment is likely to be. So, moving on to this week's 5-star review, and for a quick pause from the headlines, this is why we do what we do, is so that we can have what we would call celebrating customers that believe in what we're doing. And what we're doing is trying to share our 30 plus years of experience at helping homeowners in the journey to become a homeowner, and so that they can avoid many of the pitfalls that many people encounter during the mortgage process, which invariably is almost always due to a lack of preparation. So this week's 5-star review comes from Robin, and we closed a home for Robin last month. 5 years ago, and 10 years ago. So I think this is our third transaction for Robin. Here's what Robin had to say. Mack is the only mortgage loan officer anyone should ever use. Wow. I've known Mack for over 10 years, and he has helped us on multiple mortgage matters. That is true. This last one was a very quick and demanding close, and he and his team were able to handle it. Awesome guy and very helpful in getting you what you need. Thanks, Mac. Hey, you know what? We call that trust, and we call that E to the power of 4, where we believe in education, empowerment. It puts the buyer in a position to execute and hopefully have a meaningful experience. So thank you, Robin. And so next, let's move on to this week's Stoic quote of the week. Every week, we like to step back from the noise and ground ourselves with a little perspective. And Marcus Aurelius once said, "It's the truth I'm after, and the truth never harmed anyone." In housing, truth beats headlines every time. And I believe having a true and objective view of the transaction, the payment, the cash to close, as far in advance of actually making decisions, is the best truth for buyers and their agents to exercise with when out there looking for homes, signing contracts, and preparing for that journey of home ownership. And, because real estate is stressful, we like to have a little fun on Saturdays. So let's start with this week's TikTok video from.
Absolutely, and that's a perfect segue.
Yep,
We'll
stand
keep
down.
it light.
Yeah, stand down one moment. Let me launch this.
Oh, what fun it is to ride in a one-horse open sleigh. Ho! Jingle bells, jingle all the way. Oh, what fun it is to ride in a one-horse open sleigh.
All right, ChatGPT, Santa's prenup.
Absolutely. Santa's prenup, or should we say his escape clause, is definitely a fun way to add a little humor into the mix. Let's have some fun with that and keep the mood light. So feel free to launch it, and we'll roll with the puns and a bit of holiday cheer.
And let me try this one. See if you get this one. And if Santa set up an Antarctic headquarters, would he be?
I think I see where you're going with that one. If Santa set up an Antarctic headquarters, he'd definitely be a bit bipolar. That's a perfect little pun to keep the mood festive and get a chuckle out of everyone. Love the holiday humor. Keep them coming.
Yeah, I like this one. All hail Caesar, emperor struck by ice pellets.
Absolutely, that's a classic. Hail Caesar, or in this case, Emperor struck by ice pellets. Definitely gives a whole new meaning to a chilly reception. It's the perfect little pun to wrap up on a fun note and keep everyone smiling. Love the humor.
Yeah. So hey, share with us your favorite pun. My favorite pun is bad puns. That's how I roll. And with that being said, hey, thanks for joining us today. It's sort of a consolidated show. We have lots to do with the family today and for the rest of the week. We wish everyone happy holidays, Merry Christmas, Happy New Year, and remember, knowledge is the key to making the best decision for you and your clients. Join us here every Saturday, 10 a.m., right here on LinkedIn. YouTube, nope, not YouTube. We don't go live on YouTube, but we go live on LinkedIn and Facebook. And until next time, stay informed, stay engaged, and I'll see you at closing.